In 1985, a young economist took over the investment portfolio of a university endowment worth about $1 billion. Over the next 36 years, without ever chasing a hot stock, timing a market crash, or appearing on a single financial news segment, he grew that portfolio to more than $31 billion, beating a standard simple mix of stocks and bonds by 4 full percentage points every single year for over 3 decades. His name was David Swensen, and the approach he built at Yale quietly became the blueprint that old money family offices around the world still follow today. A set of rules that have almost nothing to do with picking the right stock, and almost everything to do with structure, patience, and what you refuse to do when everyone else is panicking. Today, we're breaking down exactly what those rules are. The ones that have survived the dot-com crash, the 2008 financial crisis, a pandemic, and are actively shaping how the wealthiest families on Earth are positioning their money in 2026. If you want the real architecture behind generational wealth, including how it's actually invested, not just protected, subscribe now. This channel breaks it all down, every week. The model that rewrote institutional investing. To understand how old money actually invests, you have to start with a single foundational idea that predates most modern family offices entirely. The Yale model, sometimes called the Endowment Model. Before David Swensen took over Yale's investment office in 1985, the standard approach at almost every institution, universities, pensions, and individual investors alike, was what's known as the 60-40 portfolio, 60% in domestic stocks, 40% in bonds. Simple, liquid, and, in Swensen's view, badly under-optimized for an institution like a university endowment that, unlike an individual investor, effectively has an unlimited time horizon. It doesn't need to retire, doesn't need the money for a mortgage next year, and can genuinely afford to think in terms of decades rather than quarters. Working alongside his longtime collaborator, Dean Takahashi, and building on modern portfolio theory pioneered by Nobel laureates Harry Markowitz and James Tobin, Swensen made a deliberate contrarian bet, dramatically reduce the allocation to traditional stocks and bonds, and instead pour a substantial share of the portfolio into what were then considered fringe, niche asset classes: private equity, venture capital, real estate, hedge funds, and even timberland. At the height of the Yale model's development, allocations to these alternative assets ran as high as 70% or more of the total portfolio, a genuinely radical departure from how institutional money had ever been managed before. The reasoning behind this wasn't a hunch. It rested on a specific, well-established principle from portfolio theory: assets that don't move in lockstep with each other, that have low correlation, can be combined into a portfolio that delivers a smoother, more stable overall return than any single asset class could deliver alone, even if some of those individual pieces are, on their own, more volatile. A stock market crash doesn't necessarily crash the value of timberland, a private equity stake, or a piece of real estate at the same time or by the same amount, and a portfolio built from genuinely uncorrelated pieces can weather a storm that would otherwise sink a conventional 60-40 mix. The results over Swensen's 36-year tenure are hard to argue with. Yale's endowment grew from roughly $1 billion to more than $31 billion, outperforming a standard 60-40 benchmark by an average of 4 percentage points annually. That gap, compounded across 3.5 decades, is the difference between large university endowment and one of the wealthiest institutional pools of capital on Earth. This is the intellectual foundation underneath nearly everything discussed in the rest of this video. Old money family offices didn't invent the idea of diversifying beyond stocks and bonds, but they were, in many cases, some of the earliest and most enthusiastic adopters of exactly the philosophy Swensen proved out at Yale. Spread capital across genuinely different kinds of assets, accept illiquidity in exchange for higher long-term returns, and let time, not timing, do the heavy lifting. What old money actually holds right now, the Yale model, is history. What does old money's investment portfolio actually look like today, in 2026? Thanks to detailed annual survey data, we don't have to guess. The UBS Global Family Office Report 2026 surveyed 307 family offices worldwide, with an average family net worth of $2.7 billion, collectively representing over $627 billion in wealth. The headline finding: these families now hold roughly 42% of their total portfolios in alternative investments, private equity, private credit, real estate, hedge funds, and infrastructure, a figure that would have seemed almost reckless by conventional Wall Street standards a generation ago, and looks entirely ordinary to a family office today. But the composition inside that alternatives bucket is shifting in a genuinely interesting way. Private equity, long the single largest alternative allocation for family offices, has been quietly trimmed, falling from 22% of portfolios in 2023 to a planned 17% by the 2026 cycle. The money isn't leaving alternatives altogether. It's rotating into private credit, secondaries, and real estate instead. Private credit in particular is being flagged across multiple major surveys. UBS, Campton Wealth with RBC, and JP Morgan Private Bank all point to the same trend. As the fastest growing sub-allocation inside the private market space, precisely because it offers something a private equity buyout fund often can't: a contractual interest payment, rather than a bet entirely dependent on a favorable exit down the road. There's a specific, almost technical reason behind this shift that's worth understanding, because it says a lot about how disciplined this kind of capital actually is. Investors managing private equity have grown frustrated by a lack of capital distributions, meaning money committed to funds years ago simply hasn't been returned yet, because the exit environment for selling those underlying companies, whether through an IPO or an acquisition, has been sluggish. Rather than staying blindly loyal to a single asset class out of habit, family offices are doing exactly what disciplined, long-term capital is supposed to do: reallocating towards structures offering more predictable cash flow and better protection against a bad outcome, without abandoning private markets as a category altogether. 60% of family offices, according to this same 2026 survey, now plan to make changes to their strategic asset allocation over the next 12 months, the highest share ever recorded in the survey's history. It's worth being precise about what that statistic actually means, because it would be easy to misread it as panic. Researchers who track the report describe this explicitly as not panic selling, but rather a measured recalibration, a deliberate, considered adjustment to a changing world, not a reactive scramble out of fear. That distinction between recalibration and panic is, in fact, one of the core investment rules this entire video is about. This is exactly the kind of current, data-grounded breakdown this channel exists for. If this level of detail is valuable to you, drop a comment with the word allocation. It tells me you want more deep dives into how real wealth is actually positioned today. The illiquidity premium. Getting paid to wait. There's a specific financial concept underlying old money's comfort with assets that can't easily be sold, and it has a name worth understanding: the illiquidity premium. Here's the basic logic. Every investor, at some level, values the ability to convert an asset back into cash quickly and without a discount. A publicly traded stock can be sold in seconds during market hours. A stake in a private company, a piece of undeveloped land, or a limited partnership interest in a private equity fund often cannot be sold at all for years, and even then, only at whatever price a buyer is willing to offer for something with a thin, illiquid market. Because investors generally prefer liquidity, assets that lack it have to offer something in return to attract capital at all. A higher expected return, over time, specifically as compensation for the investor's willingness to lock their money away and wait. Swensen's own writing on this point was blunt. Illiquidity isn't a bug in a long-term portfolio. It's a feature to be actively harvested, but only by an investor who genuinely doesn't need the cash back on a specific timeline. An endowment, by its nature, almost never needs to sell an asset at a specific moment to cover an emergency expense. And this is precisely why old money family structures, trusts, family banks, and multi-generational time horizons, all covered in earlier videos on this channel, matter so much to this entire investment philosophy. A family that has already built other sources of liquidity through the tools discussed in previous videos can afford to let its investment portfolio behave like an endowment, patient, illiquid, and unbothered by the need to sell anything on short notice. This is one of the most consistent, quietly repeated findings across institutional research on portfolio construction over sufficiently long horizons. Less liquid assets like private equity and real estate have historically offered greater potential appreciation than their liquid public market equivalents, precisely as compensation for the extended holding period and reduced flexibility. During the 2008 financial crisis, this played out in a specific, memorable way. While public equities and bonds were falling sharply in value, many alternative assets, insulated from the daily panic of a public trading floor, held their value considerably better, simply because there was no mechanism for a scared investor to instantly, publicly dump them at a fire sale price. The lesson embedded in all of this isn't avoid liquid assets entirely. Public equities remain the single largest slice of even the most sophisticated family office portfolios today. The lesson is narrower and more useful. Only take on illiquidity you can genuinely afford. And once you can afford it, don't leave that premium on the table out of an emotional need for flexibility you don't actually require. Leverage is a tool, not a habit. Old money's relationship with debt inside an investment portfolio is worth its own dedicated rule, because it runs directly counter to a common misconception. That leverage, borrowing money to amplify an investment position, is simply a tool the wealthy use freely because they can absorb the risk. In practice, sophisticated family offices treat leverage with real, deliberate caution rather than casual comfort. The same 2026 UBS survey data that shows families rotating within alternative asset classes also shows them approaching leverage with greater caution, even while broader portfolios remain, in the survey's own language, risk on and positioned for growth. This is a genuinely important distinction. Being willing to take investment risk through asset selection and allocation is not the same thing as being willing to amplify that risk artificially through borrowed money layered on top of it. The reasoning connects directly back to the illiquidity discussion in the last section. Leverage works by borrowing against an asset's current value to increase exposure. But if that asset's value falls and the loan comes due, or the lender demands additional collateral, the borrower can be forced to sell at exactly the worst possible moment, converting what would have been a temporary paper loss into a permanent realized one. This is precisely the trap that destroyed enormous, previously successful fortunes throughout financial history. Investors who were right about the long-term value of an asset, but were forced to sell it during a temporary downturn purely because they'd borrowed too aggressively against it and ran out of time to be right. This is a different use of debt than the buy, borrow, die strategy covered in an earlier video on this channel. That strategy uses borrowing specifically against already appreciated assets to fund lifestyle spending without triggering a taxable sale, a fundamentally different purpose than borrowing to amplify a new investment position. Old money's discipline runs through both applications the same way, though. Debt is a precisely calculated tool for a specific, well-understood purpose, never a reflexive habit for chasing bigger returns on a bet that might be wrong. If the distinction between using debt strategically and using it recklessly is clicking for you, that's exactly why this channel exists. Subscribe so the rest of this series doesn't get lost in your feed. Hard assets, the investments that don't need a stock market at all. There's a category of investment that has outlasted every stock market crash, currency collapse, and financial crisis in recorded history simply because it was never dependent on any of those systems to hold value in the first place. Hard physical assets, land, real estate, and precious metals. This is arguably the oldest investment rule in this entire video, predating modern portfolio theory by literally thousands of years. Land ownership has functioned as the foundational store of generational wealth across nearly every stable society in history for a simple structural reason. It cannot be inflated into existence, cannot default like a bond issuer, and cannot be delisted or halted like a stock exchange. A family that owns productive land owns something that will still exist in some usable form, regardless of what happens to any specific currency, government, or financial market layered on top of it. Gold occupies a similar, if more concentrated role, and there's a genuinely striking, very current detail worth flagging here. Reporting in 2026 indicates that gold has overtaken U.S. Treasury bonds as the world's top reserve asset, a remarkable shift given that treasuries have functioned as the default, safest asset in the world for decades. Family offices, according to the same UBS 2026 survey, are responding to this shift cautiously rather than dramatically, planning only a modest 1 percentage point increase in gold exposure and maintaining just a roughly 1% total weighting in broader commodities. This is a useful, concrete illustration of old money's investment temperament in miniature. Even when a genuinely significant structural shift is unfolding in real time, one of the biggest reserve asset stories in decades, the response is a measured single-digit adjustment, not a wholesale abandonment of the existing portfolio. Real estate carries its own distinct role inside this category, sitting somewhere between a hard asset and a productive, income-generating investment. Even amid the broader 2026 reshuffling away from private equity, real estate remains one of the most closely watched allocations in family office portfolios. UBS data flags it as the only asset class with a projected allocation change greater than 1 percentage point in the coming year, reflecting its unusual dual identity as both a tangible, inflation-resistant store of value and a source of ongoing rental income that doesn't depend on any stock exchange being open. The underlying principle tying land, gold, and real estate together is the same one that made primogeniture and entailed estates so central to old money history, covered in an earlier video on this channel. Some assets are valuable specifically because their worth doesn't depend on the health of any single financial system. A stock portfolio can theoretically go to zero if a company fails. A government bond depends on that government's continued ability and willingness to pay. A piece of well-located land, a vein of gold, or a productive building has intrinsic utility that persists across regime changes, currency collapses, and market crashes that have wiped out entire categories of paper wealth throughout history. Don't keep all your eggs in one currency. Either diversification for old money has never stopped at asset classes. A rule that's become dramatically more visible in 2026 data, though it's been a quiet pillar of sophisticated wealth management for far longer, is currency diversification. Deliberately holding wealth across multiple national currencies, rather than concentrating it entirely in one, however dominant that currency may currently seem. The 2026 UBS survey captured this shift in unusually stark terms. 65% of family offices now expect confidence in the US dollar's global reserve currency status to weaken over the coming year, and nearly half describe their own portfolios as currently overexposed to the dollar specifically. In response, nearly a third of surveyed family offices have already reduced, or are actively considering reducing, their exposure to dollar-denominated assets, with the Swiss franc and the euro emerging as the preferred alternatives, and broader multi-currency frameworks becoming increasingly standard practice across the wealthiest global family offices. It's worth being precise and fair about what this data actually shows, rather than overstating it into a dramatic headline. Analysts who track the report are explicit that this is not a dramatic de-dollarization. Family offices are not fleeing the dollar in a panic. They are asking a more measured, practical question. Given how much of our total wealth, liquidity, and political risk currently sits inside a single currency, does that concentration still make sense going forward? And would a more deliberately diversified currency footprint reduce a risk we've simply been carrying, unexamined, for years? This rule connects to a broader theme running through this entire video. Old money treats concentration itself in a single stock, a single asset class, a single currency, or a single country as a risk to be actively managed, independent of how strong or reliable that single thing currently appears to be. The dollar remains, by a wide margin, the dominant currency in most family office portfolios, even after this shift. The point isn't that the dollar is failing, it's that a portfolio built to survive across generations doesn't bet its entire foundation on any single pillar remaining unshakable forever, no matter how solid that pillar has always seemed. This is the part of old money investing that rarely gets explained clearly, the quiet, structural diversification happening across currencies and geographies, not just stock tickers. If you want the mechanism first version of this world every week, hit subscribe and turn on notifications. The rule underneath every other rule: discipline over excitement. If there's one final rule that ties every mechanism in this video together, it's this. Old money's investment edge has far less to do with superior information and far more to do with an almost stubborn resistance to acting on excitement. Consider how family offices, according to the 2026 survey data, have handled the newest, most hyped asset class of the last decade, cryptocurrency. Despite years of enormous public attention, price volatility, and no shortage of dramatic headlines in both directions, only 24% of surveyed family offices hold any crypto or digital asset exposure at all. And even among that minority, allocations remain modest, typically around just 1% of total portfolio value. This is a remarkably restrained response from a group of investors with, by definition, more spare capital to speculate with than almost anyone else on Earth. The restraint isn't an accident. It reflects the same underlying discipline running through every rule in this video, a genuine, unglamorous asset class, with decades of documented behavior, real estate, private equity, government bonds, gold, earns a serious allocation. An exciting, unproven one earns a small, controlled experiment at most, regardless of how loudly it's being discussed anywhere else. The same discipline shows up in how family offices are handling this year's dominant investment story: artificial intelligence. It's unquestionably the top investment theme in family office portfolios for 2026, drawing serious, sustained interest across power and infrastructure, AI-enabled healthcare, and defense-related technology. But the reported approach is described specifically as combining genuine conviction with selectivity, participating deliberately across a broad value chain, rather than concentrating a portfolio's fate on a handful of single, speculative bets, which is precisely the same diversification instinct discussed throughout this entire video, simply applied to the theme currently dominating the headlines. This restraint is the psychological core underneath every rule covered in this video. The Yale model's patience with illiquidity, the caution around leverage, the preference for hard assets that don't depend on any single system, and the deliberate diversification across currencies. None of it requires predicting the future correctly more often than anyone else. It requires building a structure sturdy enough that being wrong about any single bet or missing out on any single trend never threatens the whole portfolio. And then having the discipline to actually stick to that structure when something exciting or something frightening tempts you to abandon it. The actual lesson. Here's what ties every rule in this video together. Not one of them depends on predicting the next crash, the next boom, or the next hot sector correctly. David Swensen didn't grow Yale's endowment 31-fold by calling market tops and bottoms. He grew it by building a structure, diversified across genuinely uncorrelated assets, patient enough to capture the illiquidity premium, and disciplined enough to hold that structure through 6 separate market downturns without panicking, and then simply refusing to abandon that structure when the market got scary, or when something new and exciting tempted him to chase it instead. Old money's real investment secret was never a better stock pick. It was a portfolio and a temperament built specifically to survive being wrong sometimes, which, over a long enough timeline, is the only thing that has ever actually mattered. Old money doesn't just protect its capital through trusts, and its heirs through education, and its relationships through governance. It protects its investments the exact same way, through structure built to outlast excitement, fear, and every single market cycle in between. If this changed how you think about diversification, discipline, and what smart money actually does differently, subscribe to Old Money Opulence. New investigations into the real mechanics behind generational wealth drop every week. And if you want to see how this same patient discipline applies to the tax side of the picture, watch the companion video. How Old Money Legally Pays Less Tax breaks down the structures that let these same long-held assets grow with far less friction along the way. Thanks for watching, and I will see you in the next.